And in our top business story, the telecommunications market in the UAE will grow at a compound annual growth rate of 3.7% over 2016 to 2021. That's according to the latest market survey. The study by Research and Markets said that while competition between the two telecom operators, Etisalat and Du, is expected to grow further following the implementation of fixed network sharing agreements by the regulator, both together will account for 97.5% of the telecom market in the UAE. It added that data and fixed broadband revenue will grow, owing to the increasing adoption of 4G networks and fibre optic technology. Fixed VoIP will be the fastest growing segment, aided by the growing adoption of triple play services. It said that operators should focus on further diversifying their service portfolios by offering multi-play services to the residential segment and targeting the Internet of Things and machine-to-machine communications to business customers. The telecom service revenue growth will be boosted by mobile data, fixed VoIP and fixed broadband segments, while 4G will replace 3G as the largest adopted technology by 2019. Since 2015, transaction levels for Dubai properties under 1 million dirhams stand at 46%. That's according to the latest figures. Data from consultancy firm Radin GCP shows that properties between 1 to 2 million dirhams make up 30%, while properties costing 2 million and more account for 24%. According to the report, among the new locations or projects with properties below 2 million are Damax Okoya in Dubai Land and those at the IMPZ, apart from long-standing favourites such as International City and Discovery Gardens. The report added that even in luxury locations such as the Palm, off-plan options beneath the 2 million dirham mark are available from the likes of Azizi Developments, coming under the affordable luxury tag. In the ready space, the major developers account for 43% of transactions, while in off-plan they account for 35%. It was also noted that for Emaar and Dubai Properties units, the majority of transactions are above the 2 million dirham mark. They added that as the product mix continues to proliferate, the pattern of transactions will more closely resemble developed markets. It is likely that the supply pipeline, historically concentrated towards the upper end of the market spectrum, will graduate towards the mid-end of the market. As private wealth in the UAE is set to grow by 14.1% annually to reach $1 trillion by 2020, the UAE-based savings and investments company, the National Bonds Corporation, has launched a prestige wealth management program for high net worth individuals and investors. While stating that the Prestige Wealth Management Programme was launched for the benefit of more than 11,000 of the National Bond Corporation's 817,000 high net worth client base, officials highlighted that in addition to providing competitive advantages and returns, the programme will help attract 6 billion dirhams worth of investment opportunities within the company's portfolio. It was also revealed that the programme intends to educate the general public about Sharia-compliant savings and investment tools, while also aiming to provide the UAE citizens and residents with financial instruments and plans that help them achieve sustainable financial stability and security. Although private wealth helps to attain a secure future, officials also stress that sound management of private wealth, as well as financial planning that is based on a wise, clear and long-term vision, will help protect investors. The new Prestige programme will feature 3 categories in gold, silver and bronze, and each one will provide many services, including free financial planning advisory and a relationship manager for Islamic financial transactions, as well as priority in real estate sales invested by the company. In line with the recently agreed oil production cut resolution adopted by OPEC, the Abu Dhabi National Oil Company is undertaking the necessary steps to implement cuts and will inform its customers early next week about any potential change on their crude allocation for January 2017. The statement by ADNOC added that any reduction in uptake will be planned and undertaken in coordination with OPEC following its ministerial meeting, which was held on November the 30th to reduce member output by 1.2 million barrels a day. The move comes as non-OPEC producers agreed on Saturday to jointly curtail oil output by 558,000 barrels a day for 6 months starting on the 1st of January 2017. The organising of the petroleum exporting countries made the announcement following an OPEC and non-OPEC ministerial meeting in Vienna. OPEC stated through a statement that the meeting recorded that OPEC member countries, in agreeing to this decision, confirmed their commitment to a stable and balanced oil market and underscored the importance of other oil-producing countries joining their efforts.